Welcome to a Wall Street for Main Street podcast special. I'm Dawoud, and I have a special guest here, John Rubino, the author of Dollar Collapse. John, thank you for joining us today.
Hi, Mo. Thanks for having me on.
Well, John, the first subject I would like to talk about is what's going on in the Eurozone. There's a lot of events going on. We had the episode that's going on in Greece right now where they keep asking for more bailout money. And now we have a situation that's going on in Spain as well. And according to my sources, Spain will need an additional $49 billion bailout to service their debt next year. So they're going to need more bailout as well. So I want to ask you, which country is more likely to leave the euro, Greece or Spain? Or maybe neither. What do you think?
Oh, there's no way to know. But they're both a mess, and they're both unable, under their current structure, to survive in a monetary system that suits Germany. So they either have to really, really radically change the way they live. It's not just a few tweaks to tax rates and to pension funds and things like that. I mean, they just, as Mediterranean European countries, they just have very different lifestyles than the core countries in the Eurozone, and so they have to become a lot more like Germans in order to exist under the same kind of monetary policy that the Eurozone would have if Germany was just completely in charge. And that's, they're going to have to decide whether that's worth it to them. And so there's no way to know which of these countries implode first, but it's highly likely that one of them does. And the alternative is for Germany and France and a couple of the other more solvent Eurozone countries to basically just take over the system and create something more like the United States, where you've got a relatively strong central government that controls their version of Social Security and Medicare and defense all the way across the board. In other words, they get to decide how the tax system works in Spain and how Spaniards retire and what kind of health care they get and what the defense budget is like for the Spanish. And that's not really palatable to a lot of European peripheral countries either, but it might be the only way to keep the Eurozone together. So I think that's probably where we'll end up, and it'll be through a long process of just dragging these guys kicking and screaming into compromises that they never thought they would have to make. And so more than likely that's where we'll end up in 3 years' time, but it'll be a very, very messy 3 years.
Yeah, you hit an interesting point there, because you list some of the reasons why the euro hasn't worked at this point, which was going to be my next question. Another thing that I think why the euro hasn't worked is there's no central fiscal policy for all the euro countries. And when you don't have that, this is what you get. You have, countries that spend beyond their means, and you have countries that live within their means, and they get punished for doing the good thing, while all the other countries are going to need a bailout. So why hasn't the euro worked at this point, other than the thing that you just mentioned? Do you think the euro need to be backed by gold or silver, or something, back to the commodities?
Well, the Eurozone has some structural problems, which you talked about just now, which is one of which is that there's no central fiscal authority. So it's a bunch of separate countries using the same currency and going their own way otherwise. And so you get messes like this. Especially early on, the marketplace thought that all euro-denominated debt was the same, so they let Greece and Portugal and Spain and Italy borrow at extremely low rates, as low as Germany. And so they did, of course, borrow like crazy, because that's what an immature culture will tend to do when you give them an unlimited credit card. And so they end up with all the debt that they have now and that they're trying to work through in some way. Had the market not made that mistake, things wouldn't be as bad now. But going forward, even if they do the fiscal union thing and they end up with Germany basically in charge of the whole show over there, they're still a mess, because they've still got a really, really inefficient system of national health care and retirement plans and stuff like that. The system of entitlements in Europe is building up unfunded liabilities at a rising rate that rival those in the U.S. So that they're creating a system. Even, leaving the peripheral countries' problems aside for a minute, they're creating a system that's untenable because they're building up obligations to retirees at a rate that they can't hope to cover in the future. So they still got that to deal with, and that's still going to affect the value of their currency. They will still have a euro crisis, even if they fix the immediate eurozone crisis. And so but that's a problem of all mature fiat currency countries. When you give yourself the right to print as much currency as you want and you don't have to prioritize anymore, you tend to get very flaccid as a society, and you just write all these checks that your future, that your kids can't cash. And that's what we've done in the U.S., and that's what Europe is doing right now. So they still have a giant crisis out there. They're still not a viable system, but they have some immediate problems they have to fix in order to get to the point where the next set of problems becomes an immediate crisis. So, in the long run, it's a mess no matter what. And we have to repudiate the idea of paper currency that's not backed by anything. And then maybe we will end up going back to something, like you said, like a gold standard, where we take the power to create money out of the hands of governments and leave it with the marketplace. And so in that way, we restrain the growth of government spending over time and keep everybody in line. That worked for a couple of hundred years under the classical gold standard, and then all fell apart during World War I and the subsequent Depression, when we just printed as much new currency as we had to in order to survive and win the war. And then it was never possible to put the pieces back together again. But at this point, we might be able to do it, but we'd have to go to gold at $10,000 an ounce in the U.S. and maybe the same thing in euros, maybe 10,000 euros per ounce of gold. And that would be a massive deflation in the value of the savings of most people in the Western world. So it would be a painful process getting from here to there, but it's probably the only thing we can do to save ourselves.
Excellent point, but if you are a believer in a free market economy, deflation is the cure to the disease that you have in the economy. So, because when you have deflation, your standard of living increases, your purchasing power increases, wages and prices will adjust to the market price, and so that create more incentives to save, and capital will be created. So deflation wouldn't be a bad thing, would it?
Well, gradual deflation is great. That's what we had under the classical gold standard, where prices actually went down a little bit each year. But precipitous deflation, where and what I'm talking about is a deflation of your savings. In other words, your savings become way less valuable than they were. That's a bad thing for anybody who has money in the bank. Like if you've got dollars and all of a sudden we devalue the dollar in order to have a gold standard with gold at $10,000 an ounce. So that's basically a big devaluation of the dollar. Your dollars in your bank account or under your mattress or in your wallet become way less valuable. And so your life savings is partially wiped out. This causes you to spend less, which causes the stores where you would have spent money to lay people off, which causes them to spend less. And, it reverberates through the economy. You have the real risk of a depression if you try to go from here to there in a heartbeat. If we tried to just impose a gold standard this month, it would be a very painful process. And I'm not saying we shouldn't do it. I think that eventually we're going to have to do something that takes the printing press out of the hands of governments. But I'm saying that it's politically extremely risky, and that's why it won't happen until we have a gigantic crisis. It's not going to be something where 51% of the voters decide they like gold and we elect somebody and he just does it and we live happily ever after. Much messier process. The whole system that we've built up over the last 30 years has to fall apart. And we have to have this crisis of confidence in which the whole existential existence of the systems that we built up is called into question. Their point of paper money will be examined and found illegitimate. And at that point, then we can go, all right, let's tie our money to gold and just get out of the business of printing new money.
And that's an excellent point. And if they're going to go back to the gold standard, they're going to also need support from the people in the eurozone if they're going to do it. If they want to get the money printing machine out of the hands of the government. So I have one last question about the euro crisis, then we'll move on to what's going on in the U.S. economy. Now, there's some group in Germany that are pro-euro, like the politicians and the German manufacturers, and others that are anti-euro. Do you think Germany can withstand leaving the euro, or would the capital inflow that would come in and drive up the value of the mark if Germany left the euro hurt the German exporter too much and cripple their economy?
Well, Germany's in kind of a bind, so it's not a surprise that there are people there who want to stay in the euro and people who want to bail, because either course has a lot of uncertainty and a lot of potential heartbreak for these guys. Because if they stay in the eurozone, then they basically have to finance the bailouts of the entire periphery, which means they've got to take a lot of Spanish and Italian debt on their own balance sheet, in effect, which means that Germany's AAA pristine credit rating is going to be seen to be an illusion, because there's all this debt that's really theirs, that's out there. It's currently on the balance sheet of other countries, but it's going to come back to Germany, and all of a sudden their balance sheet is not going to look so clean, and they're not going to be a AAA credit anymore, and the euro is not going to be a reserve currency. You know, that's the risk of just bailing all of the periphery countries out, taking on their debt, and then financing it with newly created euros from the ECB. That's one scenario, and some Germans are in favor of it, and a lot of Germans are terrified of it. The other is where Germany just leaves the eurozone and says, "Look, this didn't work. Sorry, we're going to go back to the Deutschmark," and then the Deutschmark would go through the roof. It would become a safe haven currency instantly, especially given the chaos that would result around it in the rest of Europe. And that carries, like you said, problems too, because, excuse me. All that hot money flowing in would bid up asset prices in Germany and force interest rates way down, and cause a lot of economic instability that you see in developing countries right now, and they end up having to put capital controls on, like Brazil just did, or in smaller safe haven countries like Switzerland, where they had to peg the Swiss franc at 1.2 to the euro, and then basically going forward accept eurozone levels of inflation in order to keep their currency from going through the roof. And Germany would see all of that on a much bigger scale, and it would probably end up having to impose some kind of capital controls or have negative interest rates where you pay them in order to warehouse your money for a while. And that carries with it all kinds of problems too, because at negative interest rates, your economy shrinks. Your capital base goes down because it's paying instead of earning money for its owners. And so there are no easy solutions, because capital controls also distort the functioning of the market. And there are those who say capital controls cause more trouble than they fix. And there's a reasonable point in that. And, I think that they have been successful on a modest scale to prevent immediate catastrophe, but as long-run policy, they get you into immense amounts of trouble. And I know Germany wouldn't want to do that, but they might be forced into it. So that's the other scenario. And neither one of them is good, because Germany has gotten itself into a mess that doesn't have a pain-free fix. And so they've got to figure out among themselves which direction they're going to go. And right now, like you said, the public opinion is kind of divided, and that's because nobody wants to vote for a painful future. And so they're trying to figure out what's the least painful way to do it, and that's unknowable, because either one of the choices that they make have all kinds of uncertainties, and so there's no way to know which is the best way at this point, or which is even possible. So they're just going to have to decide, and we'll see what happens.
And that's an excellent point. Now let's shift gears here and talk about the U.S. economy and the dollar and the bond market. Now, hedge fund manager Kyle Bass is predicting that there will be a bond vigilante run on the U.S. Treasury market after there's a run on the Japan Treasury bond market and the Euro bond market. He thinks that there's 3 to 5 more years of perceived safety before there's a run in the bond market and free market forces will come in. Do you agree with Kyle?
Well, I think eventually U.S. interest rates have to go back up, and they might do it violently when people just all at once decide that it's a really bad idea to lend the U.S. government money for 30 years at 3%. That's just crazy, which it is. Right now, we are the least ugly situation among a lot of ugly situations. So there's money flowing into the U.S. from Europe, trying to get away from the immediate euro crisis, and from Japan, because Japan is just staring at this horrendous cliff right now, and it's not clear how they keep from stepping off the cliff, and so we're the beneficiaries of that temporarily. Money's flowing in, it's pushing our interest rates down, it's giving us the ability to continue to borrow at low interest rates and hide the magnitude of our deficit because our interest costs aren't very high at these rates. But at some point, here's what happens. Our policy now of basically borrowing $1 trillion a year and then financing it with newly created money from the Fed, which means basically we're monetizing our debt. We're just one branch of the government is buying the debt of the rest of the government, and that historically that's prelude to a currency crisis. And so the markets begin to see this. They don't want to deal with treasury bonds anymore. They force the Federal Reserve to basically just buy up everything that the government issues. So the Fed is financing $1 trillion+ a year in new government debt. And so the rest of the world sees this, is terrified by it. They don't want to own dollars anymore. Dollar starts to fall, and that begins to really push up interest rates in the U.S. And so no U.S.-based entity is able to borrow at an extremely low rate anymore, and that starts a death spiral in which our interest rates go up, which causes the interest component of the government budget to go up, which makes our deficit bigger, which means we have to borrow more, which makes it even harder for it. And so it goes on and on until we have this financial death spiral in which our interest costs go up and up and up, and our deficit goes up, and there's no end in sight, and everybody just gives up on the U.S. dollar. It just falls through the floor, and that's out there somewhere, very possibly. And there's no way to know when, I don't think, because these things tend to happen in a hurry, or not, but sometimes they happen in a hurry. It could just be this grinding thing where it gets worse and worse and worse until it goes parabolic on the downside, or you wake up tomorrow and everything's frozen. There's no way to know which it's going to be, and so I think it's a bad choice to bet on the continuation of U.S. low interest rates just because we don't know how quickly the turn will come when it comes. So I think it's better just to to not consider U.S. Treasury bonds a safe haven for the time being and look for other safe havens. And even if you miss a couple of years of stability, so be it, because you avoided the potential for a catastrophic failure in your portfolio.
That's a great point. And the number one holder in the U.S. Treasury is not any foreign country out there. It's actually the Federal Reserve. They're the one that monetizing most of the U.S. bonds at the auction. Now let's talk about the Federal Reserve. Recently, they continued their currency war and their bid to continue to depress the U.S. dollar by announcing QE3, which they left open-ended, very dangerous policy that they announced. Now, my question is, do you think the Federal Reserve will have the gut to raise interest rates if inflation gets out of control? Because Ben Bernanke has been out there telling people that if inflation goes up, don't worry. I'll just raise interest rate and everything will be okay. But there's severe consequences when you raise the interest rate, and you just mentioned some of them in your last response. So what do you think?
Well, back in the 1970s and the early 80s, inflation started to get out of control in the U.S., and we brought in Paul Volcker as chairman of the Fed, and he did that. He raised interest rates dramatically. Treasury rates, long-term Treasury rates, went to the mid-double digits. I think it was 15 or 16% for 30-year Treasuries back then. And that caused a nasty recession, and then set the stage for fairly steady growth in the 1980s. But we couldn't do that now because, first of all, in the 1970s, our balance sheet was actually pretty clean. You know, we actually had pretty good finances back then, so we could withstand a stretch of really high interest rates without just collapsing financially. And now, you know, we have 3 times as much debt on our books, plus derivatives, which aren't on the books but are vastly bigger than anything that is on the books. And we have unfunded liabilities that dwarf the whole size of the U.S. economy. And a lot of our debt is variable rate debt, which will spike along with interest rates if the Fed raises rates. So there's no way we could do a Paul Volcker again, where we come in and just damp down inflation in a couple of years by raising interest rates. It would just collapse the whole financial system. So that option is off the table now. So when inflation picks up, if it does, I mean, the bond or debt collapse that's going on around the world right now is very deflationary. So the world central banks are leaning against that with easy money, and these are 2 titanic forces that have never existed in the global financial system before. You know, this much debt having to be worked off at the same time. All the world central banks have unlimited printing presses and are willing to use them. You know, this is uncharted territory. But should the printing presses win, and we do start to see currencies going down in value against real stuff, which is, you know, how we would define the visible part of price inflation. Then, you know, the Fed will be faced with a dilemma because they can let the currency depreciate, which is what they really want. Okay, they know we can't get out from under this debt unless the dollar is way less valuable 5 years from now than it is now. But getting from here to there brings with it all kinds of potential instability. And so they're going to be in a place where people are going to be saying, hey, you need to fix this, you need to stabilize everything. But they will not want to stabilize it before they absolutely have to, because they want the dollar to be as low as possible when they finally do try to stop its decline. And by that point, it might be impossible. You know, they don't know what they're doing any more than, you know, you or I could run the Fed as well as the guys running the Fed are doing, because none of us know what's going to happen. And we would all just be winging it. You know, that's all they're doing. They're just trying to get through the week. They have no master plan. They have no theoretical framework in which to judge their actions or anything like that. They just want to have the global financial system not freeze up this week. All right, and that's all you and I would do. So we can't think of these guys as people with a plan, and then try to extrapolate from today's actions what tomorrow's actions will be, because there is no connection, you know, other than the fact that they kind of tend towards easy money in any situation, you know. So we know what their tendency is, but beyond that, we can't think, oh, okay, when it gets to this point, then they'll do this, because then there's nothing like that. You know, they're just going to try to keep the system from blowing up, and that is the extent of their strategy.
And that's an excellent point. Now there's a lot of people that's been arguing if we're going to have deflation or inflation, or maybe even stagflation, where we have a period of high interest, high inflation, and high unemployment. So what is your take? What do you think is going to happen down the road? I know in the beginning I came out and said I think we're going to have hyperinflation. It's going to be terrible. But that can't happen unless we have a higher velocity of money, and that hasn't happened yet. It could happen down the road, maybe within 5 years. But now I'm in the stagflation camp right now. But what about you?
Well, I think anything you just named is possible now. You know, this is uncharted territory, and I would add one more possibility. Well, actually, 2 more possibilities. One is just an immediate catastrophic collapse of the system. You know, we've created something extremely vulnerable and extremely complex right now. You know, with $1 quadrillion of derivatives in the world. There really is no way to know what's going to happen when one big derivatives counterparty, you know, one big bank that's written a lot of that paper out there and is on the hook for a ton of it, fails. And someday one will, maybe much sooner than a lot of people think. And then that'll just reverberate through the system, and it might just shut down the global financial market. So that's one possibility, you know, a catastrophic failure of the system, you know, a weekend. Another possibility is a wholesale loss of confidence in the dollar or the euro or the yen or all three put together. Maybe paper currency just loses everyone's confidence instantly. And that would manifest as hyperinflation because we'd be wanting to get rid of our currency as soon as we get some. And we'd be willing to turn it into any kind of hard asset for any price, basically. We just need to get rid of the currency because we don't trust it anymore. And so that could also happen very quickly. Weimar Germany was just a couple of years. It started with the German government printing a lot of currency, and then it turned into a wholesale loss of confidence in that currency, and then the currency just collapsed. It became worthless paper. And that kind of thing is also possible because we've created so much paper out there in the world that let people lose confidence in it, and just the sheer volume of paper that would then be turned into hard stuff. Now, in other words, the velocity of money would go through the roof, as you said, but it would do so very quickly. It wouldn't be a gradual thing where it goes up by 5% a year for 20 years. It would quadruple in 6 months or 2 months or whatever. Everybody would just instantly realize that this is the time to get out. There would be a contagion, and that's also possible. So my point is that we've created the conditions for crazy stuff to happen, and there's no way to know what particular crazy thing is going to happen first and take the system down, but we have a pretty good sense that 4 or 5 of them could happen, and at least one probably will happen.
Well, whatever scenario that might happen down the road, there's a two hard asset that people should own, and that's gold and silver.
Yeah.
And so my final question for this interview is related to gold and silver, and they're both considered as money. They both have been used as money during past thousands of years. Now, in 2012, will this be one of those rare years where gold prices and the U.S. dollar relative to other paper fiat currencies in the U.S. dollar index both go up?
Well, it's one so far, but you never really know because these markets are extremely volatile because we've created such complexity out there. And so I think the dollar has a lot going for it in the short run because the euro has so little going for it. And were Europe to get its house in order or be seen to, the odds of it actually fixing anything long run are slim to none. But it's possible that in the coming year, the euro looks like it's going to stabilize because the government has lied creatively. The governments of Europe have lied creatively enough to fool enough people that money would flow back into the euro and out of the dollar, and the dollar would go down. That's all possible. But I think that a much more interesting part of that story is gold, because over time, all the fiat currencies are going to go down. They're going to do it irregularly against each other, but they're going to do it more regularly against hard assets, because the public policy is aimed at decreasing the value of the major currencies, and printing presses are unlimited. So, we have the power to make the dollar less valuable, and we really want to. It's our explicit policy of doing so. So, the dollar will probably go down over time versus stuff like gold and silver. And so you want to have more of your zero risk assets, the stuff that you might have put in a bank account or a treasury bond in times past. That money you want to have in gold and silver now, even though they're volatile in the short run. In the long run, they're going to tend to hold their value in ways that fiat currencies almost certainly won't. So I wouldn't be able to predict to save my life what gold and silver will be at the end of the year, where the dollar index will be, or anything like that. But I think I'm confidently able to say that 10 years from now, gold and silver will be a lot higher in dollar terms than they are now, and the dollar is going to be a lot less valuable in real terms.
Oh, I agree, definitely. Well, thank you for your time, John Rubino, for coming to do an interview. If people want to find out more about what you do, or where they can find your work or your book, where can they go?
Well, I run dollarcollapse.com, which is a website that covers on a continuously updated basis all the stuff that we talked about today.
Okay. Well, thank you for your time, and hopefully we'll bring you back on in the future.
Great. Thanks, Mo.
Thank you.